Hi everyone! Rose Concepcion here. Welcome to the Money School. In this video, I will discuss mutual funds and unit investment trust funds or UITFs. What are they? Mutual funds and UITFs are both pooled funds. Many investors can participate by pooling their money into one fund, which a fund manager will use to buy securities like stocks, bonds, and money markets. The goal of the fund manager is to maximize the returns of the investors. So what's the difference between the two? Mutual funds are offered by companies and are regulated by the Securities and Exchange Commission or SEC. When you participate in a mutual fund, you buy shares based on the fund's net asset value per share. On the other hand, UITFs are offered by banks or trust entities and are regulated by the Bangko Sentral ng Pilipinas or BSP. When you participate in a UITF, you buy units based on the fund's net asset value per unit. So, as you may observe, their differences do not make them all that different from an investor's perspective. While they differ in who offers them, who regulates them, and in some terminology, for the purpose of investing, the basic concept is the same. Also, note that they are both regulated by government bodies, and so when we invest in either one, our interest as investors is protected. So, why invest in these pooled funds? Well, chances are, if you're watching this video, you belong to the middle class. In finance, we have this term for the super rich. We like to call them high net worth individuals, or BTR, which stands for Born to Retire. Those with high net worth do not need to join pooled funds because their money could even be more than the amount of money in the pool of all our middle class savings combined. They probably even own a few mutual fund companies. And so, with their huge capital, they can hire their own advisors to invest their money separately and properly allocate assets in their portfolio. On the other hand, middle-class people like us don't have enough money to diversify optimally across individual assets. Our money is not enough for our portfolio to have proper exposure to stocks and bonds across sectors and regions. And so, to mitigate our risk, even with minimal capital, we can join pooled funds where the pooled amount will be large enough to buy many different securities and be allocated in an optimally diversified manner. One analogy we can use for buying individual securities versus investing in pooled funds is eating out at a fine dining restaurant versus at a buffet. If I choose to eat out, I could choose a fine dining restaurant. But what if I don't like the meal? My risk is high. There was this one experience I had somewhere in Makati. The prices were sky high, but the food was underwhelming. Opting for a fine dining restaurant is like buying an individual stock. The upfront is expensive and your risk is not diversified. If I don't have enough money to eat at many different restaurants and the one restaurant I choose is a dud, then that's a big loss for me. On the other hand, if I choose instead to go to a well-known buffet, I have the opportunity to sample small portions of different food and increase my chances of finding dishes that give me good value for my money. Buffets are like pooled funds, wherein you can have a few bites of many different stocks or bonds and increase your chances of being profitable while minimizing your risk through proper diversification. The fund manager is like the head chef. The manager curates the fund to ensure happy clients and optimum profitability, just like the head chef curates the dishes in the buffet spread to ensure a great dining experience. So invest in pooled funds if your capital is limited but you want exposure to riskier assets like stocks and bonds. Pooled funds will ensure that your risk is mitigated through diversification. So we talked about the two popular types locally, mutual funds and UITFs. Which is better? I think that neither one is better than the other. but you need to research extensively when choosing which specific fund to invest in. Higher potential growth funds are generally better held longer term, and so you need to analyze well which fund will best suit your needs. I'll share with you my personal criteria for choosing a pooled fund. Number one, is the company reputable? I always check if the company offering the fund has a proven track record, is duly licensed, and is a recognized strong player in the country. Number two, fund risk, values alignment, and performance. I'm an aggressive investor, which means I'm comfortable with high volatility in return for potentially higher gains in the long run. I check if the fund I am eyeing is also aggressive in its placements. I value companies that are technology forward and innovative, and so I also want my pooled funds to target investing in such companies. Of course, for actively managed funds, I check historical performance to see if the fund has been outperforming the benchmark. Number three, is it easy to transact? Investing is a habit that needs to be practiced regularly. I don't want to join a pooled fund that will make it difficult for me to add more money because there are limited options for topping up my investment. I ensure that my pooled funds are easy to access and add to via online channels. Number four, are fees minimal? This is where you can really end up losing as an investor. Whether or not the fund does well, you end up paying the same fees. If year-end performance is positive, you pay fees. If it's negative, you still pay fees. This can really eat into your profit. I compare the funds of many different companies, and I usually go for those with lower fees. You may think it's just 5% or it's just 3%. It won't make that big a difference. Sure, it won't, if you don't stay invested for long. But it actually makes quite a dent if you're invested, say, for retirement, which is a goal of many pooled fund investors. Here's a sample computation assuming that you invest 3,000 pesos monthly or 36,000 per year at 7% per annum growth rate for 30 years. Sales load is the fee charged when you buy shares of the fund. At 5% sales load, your retirement fund will be just over 3.2 million. At 3% sales load, your money will be shy of 3.3 million. With no sales load, you'll get 3.4 million. It's quite a difference. This doesn't even account for other fees yet, which would make your loss even greater in reality. I'm investing for my whole family and I'm putting in more than 3,000 pesos per month. I cannot afford to invest in pooled funds with high fees because down the line that will result in hundreds of thousands of pesos lost. There is an alternative to UITFs and mutual funds that could cost you less in fees, and that is exchange-traded funds or ETFs. ETFs are also pooled funds, but they are traded on an exchange, like the Philippine Stock Exchange. And so you buy and sell ETFs like you would a stock. But this would cost you fees per transaction, and so you can save on fees by investing larger amounts at a time. Some quick calculations can help you figure out the most cost-effective pooled fund investment for you, depending on how much you will invest, how often you will invest, and how long you will stay invested. So, if there's one thing I want you to remember from my video, it's my advice that you should examine carefully the fees involved before participating in a pooled fund. Don't just rely on the fund's general description or fund brochure. Read the fund's prospectus to ensure that you are aware of all the fees that come with the fund that you are considering. Remember, money alone is not power. Mishandled money is money spent and not grown. So, invest wisely. Do your homework. Knowledge is power. So, I hope you guys got a clearer picture of pooled funds through this video, please hit that like button and subscribe to my channel. Let's learn more about money. Thanks for watching. Bye!